Hello, my name is Dr. George Mochocki and welcome to International Finance. Today we're going to be covering Chapter 3, International Financial Markets. You're taking me either on an online class or a face-to-face class, and this is a supplement to your reading material, to your the mind maps that I provided you to the second tier so you could add on, and to our lectures and our discussions in the forums if you're taking me for online or lectures in a face-to-face class. I'm going to try to keep this underneath an hour. I'm just going to give you a summation. You already have all that before you. This should be the last thing you're going to look at. And they'll give you a general idea. They'll try to tie in everything you've read so you can see the whole picture at once. And what did you forget, or areas that you say, hey, man, I must have missed that. So you could always add it in. Remember, the more senses you utilize when you read, print out my mind maps, add in more information in your own words, go to the lectures or to the forums, we discuss it, do the homework, and then when you come in here and you say you have everything else, and now when you're looking at this video, and when I flip on the mind maps, as we're going to go on here, I open up this, and you always will have this level, maybe next level. What else did I miss? And that's when you add in, stop the video, add it in, look at it, add in all the information. My whole thing is not only for you to understand the concepts, but to retain it and put it into your, store it into your long-term memory so you could pull it out, or at least know, have a general idea how it functioned. This whole course here is looking at strategic strategy, how to get into the international market, from a multinational corporation perspective. Okay, so let's look at the foreign exchange. So what's the foreign exchange market? I open all this up. We're going to talk a little bit of history, foreign exchange transactions, quotations, interpreting, and derivatives. And a lot of this you've already been exposed to in accounting, or some of it, to some point domestically, and also in corporate finance. Domestically, there's a section, corporate finance, that does touch on international, but very lightly. This is going to be more intense, a little more information to build on what you already have learned, hopefully. Okay, so foreign exchange, real quick. Foreign exchange, no different than our stock market. Our exchange allows for exchange of one currency for another through an exchange rate. So I'm converting. I have this, and to make it so it's apples with apples, for lack of better words. Some currencies are worth more than other. If we talk about Greece, the currency, very high inflation is worth useless. But now it's worth again because the euro, the banking system is refunding them again, and we're going to talk about that a little bit. Or the author, those who have already read it, you already know some information about that. Okay, what's the exchange rate? Specifies that the rate at which one currency can be exchanged for the other. The regular definitions that you should know. Okay, now a little bit of history. I'm not going to go into all history, but real quickly, gold currency was convertible into gold at a specific rate, but after World War One began, gold standard was suspended because they didn't have enough gold for all the materials or the currency. Because remember, for every dollar or whatever, there's so much gold backing it. So this, so they suspended it during the war. Okay, and then they went to the agreed fixed exchange rate, Britain Words Agreement. All right, there's the first one. Here's how we do it. The Smithsonian Agreement. They give you how do I do the exchange rates, and they were fixed. Now, fixed was okay to a point, but it didn't reflect the market, or they couldn't adjust it quick enough. So the next exchange rate, so that was the fixed one, so that changed, and now where we're at now is the floating exchange rate that is very it's very receptive, very flexible, depending on what's going on in the environment and in the financial market. So the exchange rate, the dollar could go up, the dollar could go down, and it depends on when you're actually submitting it and making a transfer of payments or funds. Okay? So widely traded currencies were allowed to fluctuate in accordance with the market forces. And since we're in a global economy, this was the best option. We finally, but historically, here's how we got to it. This is the one you have to really be concerned about. Okay? So now, foreign exchange transactions. Hang on a second. Let me just do this, clear it up. Okay, over-the-counter market, similar to what you've learned in accounting and what do you call it, for NASDAQ here in the United States. But what's the over-accounting market internationally? Telecommunication networks, where companies normally exchange one currency for another. They're not going to go to the bank over there. They do it all electronically. Most of the funds are done through electronics, for lack of better words, money going. They're not taking dollars and sending them over there. They electronically change it. They do have the currency there, but a lot of the same thing like your debit card. I don't need the money. I just get the units. Same thing when you charge online. You're on online and you're charging and you're buying something in United Kingdom, Britain, and they'll say it's so many pounds. They say it's 5 pounds. So 5 pounds got the dollar. But with the line in it, it looks like a pound. But you're looking at it and you go, hey, 5 pounds. Well, you just that's $5. But depends on the strength of the dollar. It could be $7 or it could be $4 that you're actually charged, because the exchange rate fluctuates until they charge or hit your charge card or debit card. At that time is when the exchange happens, and that's when it fluctuates. At that time, what is the exchange rate for my currency to your currency? Okay. So now foreign exchange dealers serve as intermediaries in foreign exchange market. Normally they would be banks, for lack of better words. Okay, the spot market is foreign exchange transaction for immediate exchange. I want it now. It's like a debit card. It's not like I have to wait. Here's the money. I want to change it. I want to move these funds. I want to transfer my funds right away. So it's a spot market. So you're going to go with the spot rate. What's the spot rate at that time, or the exchange rate? Interbanks are trading between banks occurs. They always do the same thing like the United States, not just globally, because the money goes, Citibanks all over. Same thing with Chase or Bank of America. They're all over, so they already got the connections with international banks. They already know how to trade. I'm going to say trading is moving currencies forward and backwards. Okay, the U.S. dollar is commonly accepted medium globally. For now, the euro is supposed to take it over, but for now, spot market time zones. When do I make the exchanges? Now, most of the exchanges are conducted only during normal business hours, banking business hours. Some places around the world, a bank is open someplace. Some large banks, because our bank may be closed, Citibank may be closed here in the United States, but the exchange, there's another bank open, and the dollar may be in the nighttime or whatever, at that time goes up. So maybe to my advantage to convert my dollars into pesos, convert my dollars into zloty, that's Polish money, or into marks, whatever. But the bank is closed, I can't do anything. So the larger bank have created a night trading desk just to make sure there's something going on, that we don't lose any money, or either way, we make money or don't lose money. So it's another way, so the bank is officially closed, but they have like a night crew, for lack of better words, just looking at the exchange rates. Okay, and spot market liquidity. Remember, the more buyers I could buy, for the market to work in a free market, I have to have buyers and sellers. If I'm selling something, I don't have enough buyers, I'm going to wait for a long time. It's not very liquid because I only got 2 or 3. We don't want it. The more buyers, the more seller, the more liquid the liquidity. I could convert it real quickly to the other currency, because somebody's going to want the dollars, or somebody has pesos or zloty or marks, and they're willing to exchange for that rate. Okay? Now, attributes of banks: they provide the foreign exchange, competitive quote, speed of execution, special relationship with the bank, forecasting advice, and advice about current markets. Okay. Now, what I want to do, remember, I always encourage students to utilize the web. You have to know the web. There's sites out there. I'm just going to open up the sites because I want to stay underneath an hour. I think chapter 2 I went an hour and a half, but there's so much information. The book does an excellent job. Don't try to just look at the videos here and think that's all I'm going to need to do. There's no way you're going to learn this material. I'm not going to go into the details and everything as the author has done. And the lectures, the more details. This is just a summation of what you already should know. It's just to kind of like put it all together for you one more time. So here's a bank on Dana. Let's go in here, and what they're basically do, there's a lot of information. I want you to just go in here. You open an account, currency exchange rates. What's the exchange rates? So you have a lot of things. Get today's exchange rates. Choose your data. Okay, open up account. So you have a lot of information in here. All right. So let me just push this back here. If I look in here, what's the dollar worth now? Here's $1. I'm going to convert to a euro. So if I give the bank $1, I want to get 92 cents equivalent to a euro. So now if I have a euro, I have €1, and I want to buy a dollar because I'm from the United States, I will get one for my €1. I will get $1, point in 8 cents. Okay, we'll talk about a little bit more about the exchange rate, but just how you convert it. You don't have to worry about. But that's at this time. Let's say about 5 hours later, something happens in the market. There's more buyers or sellers, like anything else. The exchange rate and or the currency that you're trying, the denomination you have and trying to convert, one of them, something's going on and people are trying to get rid of them, and all of a sudden it may drop or may go up in the price. So this is when you actually hit that submit button. This is the price. So you have to be really up on top of it. What's the exchange rate, and when do I transfer the funds? When do I convert the funds back to my denomination that I'm looking for? Okay, so that's the attributes. There's more into the bank. Just look at the site. We'll talk about the site later on. I always had the site. I just throw it up. People read the book, never look at the site, just this, and that's it. That's not how you're going to learn. If you're going to go into finance or even management, and you're going to, most management, most companies, they're doing some kind of international operation, and this is going to be a plus on your resume that you've had some international courses, international finance, international marketing, international business. I'll teach some of those classes also. So look me up, or ask for me. Okay, historical exchange rate movement, that's where I'm going to find out. Remember, there's a click. I just didn't want to spend the time in that. We'll spend more time in the classroom on that. I want, if you're an online, look at them. Save the sites. They work out good. Okay, what are exchange rate quotations? What's the logic? Okay, now here's the logic. When I'm looking at exchange rate quotation, here's where the language is changing a little. When I ask for something, I'm selling something. When I put a bid for something, I'm basically buying something. So ask and bid. Bid, buy, quote for a currency will be less than the ask or the sell quote. Remember, the language is turned internationally. Learn a new vocab. You may see this on the exam. Okay, bid ask spread of banks. Let's see, covers the bank cost when I look at the bid, right, to buy. Foreign exchange transactions. Remember, in finance, there's always a yield. Anything you do in the distribution, anyone who's touching something, you have to pay them for their service, like it or not. There's always a transaction fee attached to it. Okay, a comparison of bid-ask spreads around currencies. Here's the formula in here. So if I'm going bid-ask the spread, ask the bid minus the bid rate. Here's the ask, what I'm selling. Here's what I'm going to. It's almost like eBay. Look at. I was trying to figure out what would be a way that I could give you the same concept. eBay. You're right. I'm asking for something. I'm selling it. I'm the buyer. I'm not going to give you $2. I'm going to give you 75 cents for that. Whatever. Okay. And so here's the exhibit. If I'm looking at the pounds, different ask rates, bid rates. So here's what happened. Here's the bid rate. The ask rate was 160. The bid rate was $1.52. That's why I think it's worth it. So the ask, I subtract it, right, underneath the ask rate. So my spread, or bid percentage spread, is 0.05 or 5%. Remember the 5%. Those of you taking math, you got to add the zero going this way. If you had the percent here, you had two more zeros. People just think if I would have put 0.5, oh, it's still 5%. It's not. But for this one, it's 5%. Let's leave it at this one. Okay, so now here's the other one. Now Japanese yen, the bid rate was 0.007, and the ask rate was, this was the ask rate, 0.074, so it's like 4 points off. You subtract it, 0.007, and it's about 5.4%. So if I'm looking at this one, see 5.4%, this is what I was talking about. Percentage, don't look at this 5%, you got to add it over here. Okay, so it's really 5%, a little higher. Okay? Good? I'm not teaching you math. I'm just trying to bring it to awareness. So if you see a problem, you don't make the mistake. All right. So that's the one formula. Now the problem that the bed aspirate Utah bed price for a Canadian. Oh, this is a problem, and this is a problem I think in the book. They might not give you the answer. A bid price for Canadian dollars, our neighbors. Okay, 79.3. I figure 80 cents, and this ask price is 81 cents. This is what I'm bidding. I'm only going to spend less than 80 cents. I don't, but they're asking for 81 cents. What is the bid ask percentage spread? Again, 81 cents, 79 cents, right? And then it equals to 2%. Okay? Give me a second. Okay, so the next one I'm going to talk about is factors that affect the spread rate. Order cost. Remember in finance when you talk about yield, everything that I have to spend and finally what it's going to cost, what do I actually see at the end? Okay, say order costs, cost of processing the orders, including clearing costs, cost of recording transactions, there's always a paper trail in finance, inventory costs, cost of maintaining an inventory of a particular currency. A lot of times, sometimes it could be to a debit card, but a lot of people want the cash. If you're doing any business in Greece, now the banks are open again, but the ATM machines, they're all closed. The only transaction that are going is with cash. Some people don't like using a debit card for security, just rather have cash, and I got to keep the cash on hand to be able to satisfy clients coming in and says, I'm going to Mexico, I want the pesos, here's so many dollars, I want somebody, it says it's an inventory, I got to carry that cash, it's taking up room. All right. Competition, more intense competition, smaller the spread quoted by intermediaries, so there's competitors trying to keep the spread down, the cost to me. Okay, volume, currencies that have a large trading volume are more liquid because there's more buyers and sellers, numerous buyers and sellers at any given time. Okay, currency risks, economic or political conditions. You always have to be aware of what's going on with the politics, what's going on with the economy. Demand for and supply of the currency to change abruptly. Something there could change automatically. Something could, it could be an overthrow. It could be like in Greece, the people that didn't want to go along with the austerity program. They weren't paying the debt, so all of a sudden that currency change, or there could be a scandal with Brazil. The president there has some problems. They don't trust her or whatever. So there's some inflationary. There's some cost. There's some political turmoil, and the currency is dropping or is not worth as much as it used to be before. Okay, so these are all factors that affect the spread. Okay, so let me just close that off. And again, remember, the author, the book is your source. This is just something to think about. Oh yeah, I know what the spread is. Now I understand. Okay, factors that affect the spread. Okay, or I just did that. Sorry. Okay, so we're done with this one here. So now I go foreign exchange quotations. What's the logic? A little different language. I'm just going to go through it. The book does an excellent job explaining it. Just a reminder. Okay, when I'm asking for something, it means I'm selling something. Bid, I'm buying something. Bid, buy quote from a foreign currency will be less than the sell price. And I was thinking of an example, and I think eBay, those who've ever shopped at eBay, they're going to go, we do the bidding war, for lack of a better word. I want $20 for this shirt. I want to give you $2 and then see who comes up. It's a similar thing. So, all right, so that's the logic, okay? And the new vocab, ask and bid. Okay, now bid spread of the bank covers the bank's cost of conducting foreign exchange transactions. Remember, the bid is the buy. I got to cover all the costs. Comparison to the bid-ask spread among the currencies. Here's the formula real quickly. And like I said, there's more examples in the book. This is just a quick overview. Bid-ask spread, ask, right? That's what I'm selling for. Here's what I'm willing to buy for it. I subtract it. That's my ask rate. And then on the exhibit, and they use this as an example, real quickly. If I got the British pound, the ask rate, they wanted whoever's exchanging it, they wanted $1.60. and I'm going to get more in the spot market, and I'm going to say I'm going to give you $1.52, and they go, okay, fine, we'll do that. They subtract that, so here's the formula for that we had up in here, as bid rate divided. So here's my $1.60. I subtract the $1.52 and divided by the $1.60, and that ends up to 5% or 0.05. And the same thing with the Japanese yen. They subtract it, and again, the numbers are smaller. So here I am. It's 5.4%. Remember, it's a percentage. I got to add two more zeros, one more zero going this way. Boom. Remember, percentage. I move two places, so it's 0.05. So it's still 5%, but less than 5%. But remember, when I go with the 0.540, when I'm doing the exchange rate, it's not like they round off like the government for taxes. That's money. I got $1 million that has some substantial dollars attached to it. Okay, I'll move that along. Okay, doing pretty good. Okay, now here's here's a problem that was in the book, really easy bedspread. If you have something like this on a quiz, similar problem, Utah Bank's bed price for Canadian dollars is 79 cents. All right, 79 cents. All right, and the ask price is 81 cents. What is the bed ask price spread? That would be a question, and the answer is you take the 81 cents. Remember, subtract it in your calculator. Subtract that and divide it by 81 cents. Always you divide it by the ask price, and there's a 2% spread. So if you have that kind of a question, if you're not familiar, look in the book. The author has several examples, makes it very clear. Now, okay. Okay, so what factors that affect the spread? When I look at the spread, is basically if I'm looking at it as the yield, I got to pay everything else. Order costs, cost of processing, including clearing costs, cost of ordering the transaction. There's always, if you're selling or buying something, anytime you have an intermediary, a third party doing some kind of transaction, they're not doing it for free. You're going to get a realtor selling your house, he or she's not doing it for free. They want a commission. You go to the bank, you want to keep the money in the checking account, and right, if you keep over $500 or in a saving over $1,500 or $5,000, whatever, they don't charge you any service fee. If not, you have to pay some kind of fee. So you say, well, I got the thing for free. How much is eating up? If I'm not, it's better off to keep that amount. Because why? Because the amount they make you keep for the $500, they're making enough money on interest where they're investing that it will offset your service fee. If you're not, you keep a minimum, but you're still using the service, writing checks or doing everything else, you have to pay for that. Same thing when I'm looking in the exchange rate, moving funds from one intermediaries to the bank or to another intermediaries. Inventory costs for maintaining an inventory for a particular currency. I have to keep it on base. Right? If I'm going to a bank and I'm going to say, hey, I'm going to Mexico, I want to convert this to pesos, and I give them so many dollars, we do a conversion on there, they have to have the pesos there handy. I don't want it over there. I got to convert it. If I'm in Mexico, I can give them the dollars and convert it right away. But here, I want to go there already with the conversion, so I'm not being taken advantage. I'm going over there with the currency. Okay. Competition, more intense competition, the smaller spread quoted by intermediaries, other banks. They may want my business. I don't have to use this bank to go convert it. I could go to another bank that, because I've got an account there, may not cost me more. Or if I don't have an account, they have a better rate. Okay. Volume, currencies, they have a large trading volume, like the US dollar, are more liquid. That's why US dollars, they're accepted everywhere. Even when we go up and down, the greenback is still solid, for lack of a better word. Euro is another one, a little bit questionable with Greece. But there's other currencies that are more liquid than others. The ruble, for lack of better words, the Russian ruble is not as liquid, it's so controlled. You know what I mean? So you don't have that many buyers for the ruble. Maybe in certain areas, but not as much as for the dollar at this present time. Okay, and what's the currency risk? Economic or political conditions, demand for supply of the currencies to change abruptly. Look what happened to Russia. They put an embargo. They said we can't have so many certain things you can't buy, or whatever, or just some unstable situation politically going within that country that your subsidiaries at, or where you're going. So all of a sudden, that currency, the denomination of currency, either goes up or goes down drastically overnight. You got it. What happened? I woke up. I'm broke. Not this, or I'm better off than before. Always think positive. Not the glass is half full. The glass half empty. The glass is half full. That means there's more left still. Half empty means I'm going down. Okay. So we have that. No problems. We took care of that. Okay. Let's look at interpreting foreign exchange quotations. Okay. So if I'm looking at interpreting. I think that's where I'm at. Interpreting foreign exchange exhibit quotations. Here's the quotations, the direct. Here's the formula on that. Again, here's the... Okay, I might have missed something here. Let me go back. I threw my off. Let me see. I did the bed, foreign exchange, the web, ask the bed, spread. All right, I think this is where we're at. Factors affecting the spread. Order call. Okay, perfect. I get sidetracked. Sorry. I put you on pause. You may not heard it because I had to answer a phone. Okay, interpreting foreign exchange quotations. You have direct versus indirect quotations at one point in time show several time periods or semesters in this one. So if I look at €1 quoted spot market or spot market, sorry, sports market, spot market at $1.03 for lack of better words. As U.S. The dollars is the direct quote since it is in dollars. Remember, dollars from the host country made dollars. That's a direct quote in dollars. Indirect quote, I turn around the inverse is equals $1 equals $1.03 equals 97 cents, which means 97 cents euros. I get 97 cents for my $1. When I take my dollar, I convert the dollar into euros. I'm going to get 97 cents. So that's my indirect. The direct is always going to be the dollar. The indirect is, especially because we're looking for multinational corporations here at the U.S. That's the focus we're looking at. Okay? So the 97, that's all it means. So that's direct is the dollar. This is what the dollar is. Indirect is the inverse of it. Okay? So now I'm looking at direct, and this is just what it's going to say. Here's the Canadian dollar, at different start points. Okay? Different semester points. So if you're looking at what it's worth. Canadian dollar, 66 cents to the euro. The Canadian dollar is only 66 cents. The euro is $1.31. Japanese, okay, in a different quotes. The dollar is a direct one. Okay. Now, let me go in here. Direct quotation. Let me explain that. Maybe I should have did that later after I explain it. Well, you already read it, so you should be pretty good. Okay, direct quotation. The value of foreign currencies in dollars. Number of dollars per currencies. Example, $1 per euro. Appreciation. Euro against the dollar. Based on an upward movement of direct exchange rate of the euro. Indirect exchange rate of the euro is declining. So one is going up, one is going down. Remember, direct against the dollar. Indirect is the inversion on that. So if it's going up, the other one's going down. It makes sense. I'm transferring one over the other. Okay? Now, indirect, number of units of a foreign currency per dollar. Example, and this is the European Union. See with the lines in it. The euro, sorry, European Union, euro is 71 cents per dollar, right? Indirect quotations is 1 divided by direct quotations, all right? So I'm just turning it around. Okay, so now I'm going to do it as a depreciation based on the downward movement of the direct exchange rate against the dollar. Indirect exchange rate is going up. Just always thinking of what are they asking? When you look at this, what are they asking? Look at the book. I can't. I got to keep this under an hour. I have a lot of information. You have to. This is just thinking. I don't understand this, Dr. George. Read the book. Look at the examples. That's the only way you're going to learn finance. The only way you're going to learn math. I could spend times going back and forth and confuse you more. Look at it. Here's the definitions. And we already discussed it, and now you should know it by this time. Okay? And here's an exhibit. If I'm looking at, here's the direct exchange rate, indirect exchange rate. There's the correlation, relationship over time between the euro's direct and indirect exchange rates. Okay? Look at it again. Okay, so now sources of exchange rate quotations. Here's Yahoo Currency. Let me see what I have on here. Because I put on some of the currencies. They have it. Okay, again, it just shows you how to transfer it over. This exchange rate of 92 cents on July 20th. View a 5-day trend. Let's see what the 5-day trend was. Did it change any? Okay, okay, maybe it's in here someplace. All right, but play around with it. You can find out in there what the 5-day trend is, because it's information that you know. Okay, now cross exchange rate is the amount of one foreign currency per unit of another currency. An example. Cross exchange rate. Assume Poland. I'm Polish. I showed this in the author must have knew that. Currency, the zloty, that's gold, is worth 17 cents, and the Japanese yen is worth not even a penny, right? 0.00. What is the cross rate of the zloty with respect to the yen? How many yens equal one zloty? So here's the answer: 17 zloty, and that and here's the Japanese yen. So it's 21.25. So one zloty. I turn in one of my zloty or dollar or currency, whatever it is, I'll get 21.25 yens as an exchange rate. Okay, sources for exchange rate quotation. It's all right. Again, you have Yahoo. Now this. Let's see. When I looked at this one, the reason. Okay, it didn't come up. So I got to update my thing. Look at the sites. You don't have to spend much time. Looking at them, and say, could I utilize this information? Does it make sense? Try to start looking. You're not going to learn about finance or anything else just by looking at just talking about it. I have to actually see in graphs or the trends or what's actually going on. And remember, some of the sites you go in there, they also have help. They also have definition. They'll help you understand what's going on there. So you read the book, you went to the lecture, it's still confusing, look at the sites, and that's how you're going to learn, or bring it up in the classroom and we'll discuss it. Okay, currency derivatives. Remember, now, first of all, what's a derivative? It's derived from something else. It's not the whole thing. It's derived from a certain other type of a fund or a currency. So let's look at currency derivative. Contract with a price that is partially derived from the value of underlying currency that it represents. Formal definition. Remember, so when you've read the book and I didn't give you this portion in here, only had this, and you wrote down what you think, does it make sense with this one? Okay, so if I would have wrote this, I would just want price as partially derived. I would have dropped all this because I already read it. It's in here. I'm giving you more verbiage than I would normally have in my own concept maps. Okay, now what are forward contracts? Agreements between a foreign exchange dealer and an MNC, multinational corporation, that specifies the currencies to be exchanged, the exchange rate, the date at which the transaction will occur. I'm kind of like predetermined. Here's what it is. Here's when I want this to happen. That's a forward contract. Here's my exchange rate that we've agreed on, and at this time this will occur. So forward, okay, so that's a forward contract. Now forward rate, exchange rate specified by the forward contract. This is what a forward rate tells me what my exchange rate is. In the contract, we agreed. A little bit like hedging. We'll talk about that a little bit later. Okay, now you have a forward market, over-the-counter market where forward contracts are traded. Now these are contracts I could trade. Here I have a contract. It tells me what it is. I've got the contract. I've already done it a date, but I may be able to sell it or do something else to a forward market where forward contracts I could trade them. I've got it. I didn't, maybe 6 months or 7 months in advance before the contract is executable, and all of a sudden the exchange rate's going up and down, or it's not stable, for lack of better words. We could at this time sell that because I got a good deal with the contract at a forward market. People buy it. Hey, I need that. This will be good. I'm taking a gamble on that. Okay, currency futures contract, similar to the forward contract. Okay. Now this is future contracts. Contracts, but sold on exchange. This is strictly on exchange. It's a future contract sold on exchange. The standards specifies, here's what's on the forward contract, a currency futures contract, sorry, specifies the volume of particular currency to be exchanged on a specific settlement date, futures rate, exchange rate at which one can purchase or sell a specific currency on a specific settlement date, future spot rate, rate that will exist in a future point in time and is uncertain as of today. That's my future spot rate. And it'll explain a little bit more. Okay, currency option contract. So this is my currency futures, currency option contract, currency call and put. Two new concept you're learning now. Currency call provides the right to buy a currency. I'm calling, I want to buy something at a specific strike or exercise price or exchange rate. This is what it's gonna, here's what my strike price is gonna be to buy this currency at the specific time period at the specific price. It's called a strike price or an exercise price. The author uses interchangeably depending, on corporate finance, depending on the book or the publication that you're reading. It's either one, they're interchangeable. Okay, just a different way of saying it. Okay, currency put. No, so this one's buy. If I want to call an option, that means I'm basically buying. If I want to put an option, that means I'm selling. I'm putting it for sale. Okay, and again, similar is what do I want it on? What's my strike or exercise price? When is a specific period? Again, the closest thing I could think, if you're not familiar with the financial market, would be eBay when you're bidding for it. But in eBay, I'm not bidding for it. I already know what I'm going to do. Because sometimes even in eBay, I'm trying to put it that way, it says you could buy it right now at this price. Boom, a specific time, or you could see if you get a better deal going in the future. Okay, so it's option contracts, an option to buy or an option to sell. I already set that up. Okay, so now that took care of everything that you needed to know on the foreign exchange market. Doing well. Now let's look at the international money market. Okay, it is just a symbol of abbreviation, so I don't have it OA out here. What do we have on the money market? Okay, origins of development. I think I'll just go a little bit on this. Okay, so you had the European market. If you had Int'l business or a lot of things, European market developed in 1960. Euro dollars or euro currencies. I got in bolded. You should know the definition. Dollars deposited in banks in Europe. Remember, it's like the C with the two lines in there. Okay, and you had the Asian money market centered in Hong Kong and Singapore. China's got some control in there, and it originates as a market involving mostly dollar denominated deposits. Okay, dollar's still pretty good. Okay, money markets and interest rates among currencies. Market interest rates. Dependent on the demand for short-term funds by borrowers, related to the supply of available short-term funds that are provided by savers. Remember, you've got the Japan's comparison to national money market interest rates. Geez, Japan's we're low. Why invest in there? It's good if you're in there if they will give you the loan because the interests are low. But investors are going to say, hey, 0%. I'm going to go to Brazil, but you got inflation rate. Let's compare international interest rates. Look, Brazil's going high, but we'll talk about that later. Australia is another good one, right? If I'm going to do something else for interest, if I want to remember what is my market interest rates. Here it'd be high if I want to take a loan out, but it'd be pretty good if I am the one that basically has the funds, and I want to, and somebody else needs to buy my funds. Okay. Good graph. Okay, money rates vary due to the differences in the interaction of the total supply of short-term funds available, bank deposits, in a specific country versus the total demand for short-term funds by borrowers in that country. Big mouthful. Okay, now integration of money market interest rates. Money market interest rates among countries tend to be highly correlated. There's a correlation. Remember, business always a correlation. What goes up, what goes down. Interest rates, there's a good correlation among the interest rates over time. Okay, when the economic, now let's look at the correlation. When economic conditions weaken, corporate need for liquidity declines. Economics there, we're not growing. I don't worry about liquidity there. I'm just going to hand it out. And corporation reduces the amount of short-term funds they wish to borrow. Remember, they borrow the short-term funds. If you've taken me for retail management, we talk about inventory and everything else. I have to have the inventory buy. A lot of times, a lot of manufacturers or businesses have to buy the inventory 6 months in advance before it actually goes on the shelf. So, but because the economic condition weaken, I don't have to buy that inventory because I haven't. I still have inventory in stock, and there's not enough customers. The demand is down, so that's why my liquidity declines. When economic conditions strengthen, again stronger, an increase in corporate expansion, corporation need additional liquidity. I need cash to support their expansion. What could I turn in? What could I sell? How do I get it back in there? Risk of international money market securities. International money market securities. Debt securities issued by multinational corporations and government agencies with short-term maturity less than 1 year. Okay. Perceived to be very safe from the risk of default. That's the risk. But international money market securities are not exposed to credit risks, are exposed to exchange rate risk. Not to the credit, it's exchange rate. What's my currency worth? The credit is something within that, what do you call it, in that host country or in that country. The exchange rate is my what I would consider risk of market security. Remember, securities are bonds or stocks. Any kind of instrument that I'm making some money on. All right. So what did they find? When currencies denominating when the currency denominating the securities different from the home currencies in the investors. Remember, you had the inversion with the dollar and the euro. Okay, so we finished there. Looking good. Okay, so that took care of my international money market. Now let's look at international credit. When I look at international credit, let's look at the regulations. Single European Act, what does that tell me? Capital can flow freely throughout Europe between the 17 members. Banks can offer a wide variety of lending, leasing, and securities activities in the European Union or EU. Regulations regarding competitions, mergers, taxes are similar throughout all of the EU. So I have to know the terms and conditions. Bank established in any one of the EUs has the right to expand into any or all the other EU countries. So the bank, if they want to open up a branch, they don't have to get any kind of special permission. It's like the United States. Well, they do have some regulations, but it's not as hard if I'm going a Mexican bank or you're going to come here in the U.S. to set up as a what do you call it, for lack of better words, a branch. So that's what they're saying. The European Union is like the United States. The banks could open up as long as they're following the regulations for the United States, not for the one state or country. Okay, base accord. Number 1, there's 3 accords. You should be aware of them. Central banks of 12 developed countries establish a certain protocol, a certain regulation, a certain accord. Banks must maintain capital equal to at least 4% of their assets on hand. Banks' assets are weighed by the risk. Attempts, okay, now, so that was the first accord. Now the second accord, attempts to account for differences in collateral among banks. So there were some issues, so they're redefining it. This was the first stab on it, 4% assets. Now, what is the difference in collateral among banks? Encourages banks to improve their techniques for controlling operational risk. Requires banks to provide more information to existing and new shareholders about the exposure to different risks. I'll leave it at that. I'll never finish in an hour. Okay. Basel Core number 3. New methods of establishing risk-weighted assets would increase the level of risk-weighted assets, require banks to maintain a higher levels of capital. So remember, it's international credit. It's the banks. It's kind of to make sure the bank is uh, a stress test, what we call here in the United States domestically. It's kind of like a stress test internationally. Okay, now look at the credit market. Medium-term funds, terms loans from local financial institutions or through issuance of notes, medium-term debt obligation in the local market. Euro credits or euro loans, loans of 1 year or longer extended by the banks, so it's not short term. London Bank offer rate, LIBOR rate, and there's some big issue that was being manipulated. Remember, there's something at that rate and the other. It's like if I look at the LIBOR rate, it'd be similar to like the Federal Reserve looking at the interest rate. But here, so people are looking at that rate for the credit rate, and they're based off of that. So if you're manipulating that rate, you're increasing the yield for somebody, or the cost for that currency. To avoid interest rate risk, the banks commonly use floating rate loans with rates listed tied to LIBOR. Okay? Now, syndicated loans. Why do we need syndicated loan? Sometimes a single bank is unwilling or unable to lend the amount needed by the MNC or government agency. So I'm syndicated. So syndicated banks form to underwrite the loans. The lead bank responsible for negotiating the terms of the borrowers, and the other ones are working together, kind of like a joint venture, for lack of better words. Okay, impact credit crisis. What happened in the credit crisis? Triggered defaults by subprime loans. You've learned a lot of that in corporate finance. Led to a halt in housing development, which reduced income, spending, and jobs. And financial institutions became cautious with their funds. Because they all, remember, when I look at the subprime loans, a lot of times, a lot of the mortgage loans were all grouped together and sold as an instrument to somebody else. And because that crash and people were investing in that instrument, and it crashed, it affected the economy and affected the banks that was the one that was underwriting it, or saying, yes, we are promoting this instrument. It's a solid investment. What happens is, now that all that happened, and they're going, we paid, we lost money, we survived. A lot of banks went under, they didn't survive. The market took care of it, cleansed it out. So now the banks are being very, very cautious. You almost have to have gold all over you and walk on water for you to get a loan. And it's lighting up, but I mean, because of the crisis. So now the banks are beginning loosening up a little bit more. They've got good credit. They've got the solid base of people that are always paying. Those are the only ones who receive the loans, in the housing and financial with the mortgages. Now they're beginning to say, okay, we could take a little more risks. Remember, when somebody is not as creditworthy as before, and I, as a bank, are providing them a loan or a mortgage, and they have not the best credit score, I charge them a higher interest rate. I'm willing to take that risk because I have enough to sustain it. You have to take a little, to make some money. You got to take some risk, but calculate it. Before, they just wouldn't do anything. Now they're loosening up the money. I've got all this money, but if I don't put it back into the economy, there's no jobs, there's no work. People aren't going to be depositing because they don't have any jobs. They're not using my services, so I got to open it back up. And that's what the UC banks are doing now. Okay, so that took care of our international credit market. Let's talk about the bond market now. Usually I'd go with the stock market. Let's go with the bond. Remember, the bond market, when I look at securities, is bonds and stocks. And I shouldn't be preaching to the choir. You already had corporate finance and accounting and all this. So if I'm looking at the bond market, it's a step sister to the stock market. Okay, foreign bonds issued by a borrower foreign to a country where the bond is posted. Issued by foreign borrowers, for lack of better words. Okay, Euro bond. Features a Euro bond. Variable bond, similar to ours, convertible or callable. Remember, convertible, I could convert it into stocks, or callable, I could pull it back. It's like my mortgage. If the interest rates drops, I could say I could refinance. Remember, the banks could also say, hey, George, you got the mortgage. I know it's 20 years. I need the money now. I'm calling my note back. Terms and condition, annual coupon payments, no different than the domestic bonds. Only that the bearer of the bonds are in Europe, and I'm buying the Euro bond, or the Chinese are buying the U.S. Treasury bonds. Okay, denominations of Euro bonds. Commonly denominated a number of currencies, no problem. Underwriting a process. Multinational syndicates simultaneously placed in many countries. Again, the bonds. Think of the initial public offering that you learn in accounting, that you learned in finance. There's a secondary market for the bonds. I've got this IOU. It's 13%. I need some cash. I'll sell it to you at for 10%. So you're making 3%. Or you say that's not good enough. I need 20%, whatever. You know what I mean. So what you so you're getting it as a discount, and you're making you're returning investment for that amount. But what's happening? You got to wait till the bond is at maturity for you to get your money back. But you're getting the interest coupons until it reaches the maturity date on that, and then you get the full amount back. Okay, so that's the secondary market. Same underwriters who sell the primary issues. Impact of the euro. Before the euro adoption, many countries issued bonds denominated in their own currency. Right? Some people. So now, after the euro adoption, many bonds issued in the euro denominations. Market is much larger and more liquid because I had more buyers and sellers. Economic free market. You can't have only one buyer, and if more sellers, you need more. You need to have that balance. Okay, so that took care of the euro. Okay, so now we've got other bond markets developed in Asia and South America. Bond market yields among countries highly correlated over time. Economic conditions. Same thing like that happens anything else with the currency. Aggregated demand for funds decline, right? Need it. With decline in corporate expansions because everything is slowing down. Economic conditions strengthen. We've already had it in here. Where the heck we had it? I think we had it up here in the credit market. Okay, economic conditions strengthen. Aggregated demand for funds increases, but people want it because of an expansion. So people are willing to put out more bonds because they want to take care of their expansion. Global integration of bonds yields. Your risk of international bonds. You have an interest rate risk. Potential for value of bonds to decline, responding to raising long-term interest. Exchange rate risk. Potential for value of the bonds to decline. From the investor's perspective, currencies denominating the bond depreciates against the home currency. Liquidity risk, the value of the bond to decline because not a consistently active market for the bonds. People don't want my bonds, so how liquid is it? Remember, your most liquid thing is your cash, and the other ones is accounts receivable. You learn from, what do you call it, corporate finance, and the next one is bonds. Stocks, maybe not, depends on the company, but bonds are IOU. I can still transfer if, is the risk. It's not consistently active for the bond market, as long as there's buyers and sellers, am I right? The credit risk, again, represents a potential for default. Okay, Greece on bonds, real quickly, spring. I'm not going to go through the whole thing, but you could look at it, okay? Concern, so I could just stop in May. And contingency factors weaken some European Union. Many European countries and International Monetary Fund agreed to the new loans. Remember, and this one was here, 1, 2, 3. Just currently speaking, they're ready to go default. The banks, I think the European Union and the powerhouse is Germany, accepted the new requirements or presented the new renegotiate. I think it's really negotiated too much, but it was voted on. So now they're giving them money back into the systems. Force creditors to recognize that a government debt is not always risk free. Okay, and this is agreed to new loans. This is a new one. The contingent effects weaken some European countries. Force creditors recognize that government debt is not always risk free. A lot of people, when they're buying government bonds or debt, for lack of better words, hey, if I buy U.S. Treasuries, U.S. goes under, big, what can I do? But if I think there's going to be something going on with the U.S. dollar, I start shifting my funds into the euro or someplace else where I get a higher return or break even until I see what happens. That's the wise thing to do. It's no different than, think about it as a bank. If you think your bank is, something's going on with your bank and it's going to default, don't you take your money out before it happens and put it someplace else? Even though it hasn't happened, you're shrewd. You're a finance manager. You're anticipating what's going to happen in the future. The signs are going that way. I have to, yours to make sure you maintain shareholders' wealth. So I don't want to wait till the last minute. I got to take that gamble. I got to face reality, for lack of better words. Okay, let's look at this one. We're doing pretty good. Yeah. Look at my clock there. I think I'm making underneath an hour. Okay, here's the web, stocks, and Wall Street Journal. I get to, those of you in this class, I may require the Wall Street Journal. You get a discount. It's going to cost you so much. I had to play by ear. I like the Wall Street Journal. It gives you current information. It keeps you going on. It gives you the numbers, but it gives you strategically what's going on in the environment, what's happening, what new regulations are coming in, what new regulations are being phased out, what different countries are doing, what's happening in the market, so you got a good pulse real quickly every day. And it's not, good information, a lot of information, not too much junk. There's a lot of information, packed with a lot of information. And every day, if you just read it and pick up the whole thing, you already know the trend, what's going on with the finances, not only in the United States, but internationally. All right, so there's your site. Let's see, do I have that? Right, you got advertising, marketing, they have stocks. You want to enter symbol or country. Let's see what ComEd is. I just want to see if they have, see how this thing works. Okay, I'm going to look for it. Didn't have ComEd, you had everything else. Let's see, okay, so I just threw that in there, markets. So here's what the account, because you want to see on them. Here's the quote, here's what's going on with that. Price of the volume, how many showed, open, bid size, again, the ask size, what we're talking about, previous close. You're looking at what's going on, compared to what? And what I want to compare, do I want to compare it to the NASDAQ? Do I want to compare it to the SP 500? This is all this is all within the U.S. But they'll have one in here, if I'm mistaken, that they'll also have for the economy, and they have different markets. Okay, markets, mutual fund, sectors. All right, I won't go on there. Play with it. I open it up. I got your attention. What I'm doing with this site. Wow, look at all this information. And then here's intraday. What happened with the stock over the week? Shows you what's going on. What happened in a month? My goodness. What happened in 3 months? 3 months, it seems to be leveling out. A high period. You see how it's going? Here, levels out. And then 1 year, oops, drop down. All right, here's where it's at. Are we okay? Read it. So you have to look at the numbers. Okay, you got the performance, the monthly performance, everything you need to know, and they'll give you more information. Find out that they got different currency. They have videos that will talk you through there, give you some information to learn. Okay, I'm just whetting your appetite, because if you're taking this class, and a lot of people are taking the class not only to get the credit hours, this is going to be your discipline, or this is your passion, and you love to make money, but you're not sure the U.S. economy is where you want to keep it, because the Fed may raise the rates up. It's bad if I'm trying to get a loan. It's good if I'm trying to buy stocks and bonds, because that is going to be my my pivotal point, my compass, my kind of direction by the interest rates for this one economy, what's going on here. Okay? And provide links to many stock markets. That's basically this one will do. Okay, let's look at foreign markets. Impact of the euro. European Union, our competitors. And a lot of times if you're doing a global, Mexico, Canada, European Union, very similar, still Westerner. If you go to China, you still have to do some, but a little different, because there's a little cultural, even though the culture is different, a little different way of doing business in China. That's why a lot of businesses, small or medium or large, are open up subsidiaries there to understand the market. No different than when you have Chinese investors come in here. They kind of get a feel for the market, hands-on, and they go back. They know what they're doing when they're doing trading or buying. Okay, so some U.S. firms issue stocks in foreign markets to enhance the global image. I just want, I sell my stocks at their exchanges, for lack of better words. The European-based MNCs, multinational corporations, result in more stock offerings in Europe by U.S. It just gives it an offer, gives it a choice. There's a market. People want to buy it. Could I do something there? Okay, so my MNC are basically exchanging their stocks or bonds in that currency, not only in the U.S. market. Okay, now foreign stocks in the U.S. Yankee stock offerings. What the heck is a Yankee? I'm going to go, okay, these are the different ones that you should be aware of. Yankee stock offerings is non-U.S. corporations that need large amounts of money. They're going to open up stocks in the U.S. American Depository Receipts, ADR, certifies representing bundles of stocks. ARD shares can be traded just like shares of stocks. Okay, so far, so American Depository. The next one we have is non-U.S. firms. Okay, non-U.S. firms listing on the U.S. exchange, on the U.S. exchanges. Hey, I've got my number, I got my symbol, I'm a global. I'm going to open up here if I meet the requirements and everything else. Or like the New York Stock Exchange, somebody's got to leave. I got to buy the seat. They only have so much. It's been there for a while. I could, look at the Nasdaq, American Stock Exchange here, but I'm a foreign company that's selling my shares right here in the U.S. exchange. I don't have to go to their exchanges. I'm doing it right here. Okay, one-stop shopping. Okay, shares listed in New York Stock Exchange, Nasdaq market, so that the shares can easily be traded in the secondary market. Okay, now affects this Sarbanes-Oxley Act, or what we call SOX, not the White Sox. All right, non-U.S. firms place new issue stocks in the United. Okay, here's what happened. All this is the SOX Act is new regulations, everything else because of Enron and everything else with the auditing, and so what they did, the government passed laws and regulations that and we've covered that I think in one of the chapters, in chapter 2 if I'm mistaken, if I sign off as a chief financial officer, sign off saying that these, or whatever level I'm at, that these financial records are honest, even though I did not create them, I can't blame the computer, I can't blame my direct reports. I'm the one who's saying, yes, this is legal, I'm signing off, this is truthful. And if it's not truthful, I could be fined. I could do jail time by the Securities Exchange, or if I violated some other laws, I could be held accountable, not just the organization, but because of this, I'm held accountable as an individual, as a chief financial officer, as a vice president, as whoever's signing off for whatever. Because of those rules, many U.S. firms place new issues of stocks in the United Kingdom. Hey, we don't need that. I mean, I'm going to be, I don't create the reports. I should trust. Maybe there's an error, and I'm going to be penalized. And you look at it, you may not go to jail, but if they think there's something wrong, so what they did is, because there was a lot of that's what happened with the financial meltdown and everything else. So now the government just put so many rules. What SOX is hurting more the small businesses here, because I'm not going to have accountants. I do more paperwork than I do that's required. The paperwork should be done at the medium or larger corporate operations. They have the financial and they have the personnel to be able to do it. They're on a larger scale. But so that could change. So what's happening? Investors are going, hey, heck with this. If I'm going to do it, issue new stock, I'm going to go to UK. It's close enough. And I'm looking more for the secondary market instead of the U.S., United States, so they would not have to comply with the law. Okay, investing in foreign stock markets. Many investors purchase stocks outside of the home country. Right now, interest rates, it's good if I get the loan, because I don't have to pay, interest is inexpensive, but it's not good if I want to buy stocks or something else, or because I'm not getting anything. I will for lack of better words, go outside. Okay, issuing stocks more frequently, comparing size of stock markets. Okay, so here's just different, let's see, stock exchanges, different exchanges, market capitalization, number of companies listed. Okay, so if I'm looking at the stock listed, okay, in Argentina, 107, Australia, boy, you got a lot of companies listed there, down under. All right, what do we have? Brazil, China, a lot, 2,400, Hong Kong, 1,500. Where's the U.S. at? Here we go, United States, we've got the most. I'm gonna look at countries, all right, and this one is investing in foreign stock markets. We have the money, we have the capital. We make money on money. We don't make money sitting around. Remember, that's finance. Doesn't do you no good. Sure, I have it. It's under my mattress. Even at 1%, I would have more over 10 years than I have now. Okay, so that's had the effect on that. We took care of that. Okay, now if I'm looking at market characteristics vary among countries. Finance. What you've learned in corporate finance over and over. I know your instructors push that. What's corporate finance? Terms and conditions. All terms and conditions aren't the same. When I go to a car deal, all the rates are maybe different, their warranties are different. You know, different banks got different terms and conditions. Some will give me free checking. Some will give me a free now account, got some interest. Some I had to pay a service fee. Some will give it to me. I only had $100 and no service fee. Some $1,000, depending on the bank, depending on the operation. That's domestically. Now let's go into another country. Remember, you have to follow by their rules or their requirements. Okay, so rights vary by country. Legal protection of shareholders are different. Government enforcement security laws, how strict are they or not? And accounting laws are different. Remember, you're going to look at international, like the GAAP, general accepted accounting procedures. But if I'm looking at, right now, the accounting is going through a whole, they're already developing, and it's already going to be in place. We're going to have a standard, I keep saying one world order, and it may be that one unified accounting principles, practices that everyone, no matter what country you're at, we all have the same. So I'm looking at their balance sheets, I'm looking at their cash flow, it's giving me the same interpretation. Not that I have to understand what the interpretation of terms and conditions are for that country. Okay. Integration of stock markets. Stock market conditions reflected by the host country conditions. Country is integrated. The stock markets will also be. That makes sense. If I get an integration of different countries, my stock market's going to be integrated. As you saw, the United States, overseas or domestic. Okay, integration in national stock markets and credit. Key link is the risk premium. Risk premium is what's the risk. If the risk is high, I want a higher return. I'm going to charge you a higher interest rate. If there's very little risk but it's stable, I just want to keep the money safe. I may not get as much interest rate, but I know that currency is going to be there 5-10 years. The government will never change. If it's a country that's very vital, very turbulent, for lack of better words, more of a market. The dollar, the currency is going up or down, so it's going on with the political. I expect a higher return, or I pull the money out of there. Okay? All right, what do we have in here? How financial markets serve the multinational corporation. I know it's a little dry. I've done. I'm trying to keep underneath an hour, so I'm sticking right to the point. I'm not giving you too many examples. See if I can make this. I'm getting better with this. I could talk for 2-3 hours, but you'll fall asleep. Yeah, maybe that's how I'll pay off my. Fall asleep may not be too bad. Okay, I found a way to put people to sleep. You don't have to, without any pills. But look. Finance, you're learning terms. It's like learning a new language. You're going over and over. You're taking on. There's a lot of vocabulary here. I don't want people to say, "Oh my God, my head's spinning. It's only in chapter 3, and I've already learned more than I've done that I've done in the last 3 weeks. All these new terms. You will do well in my course. I will help you along. You will do well. I'm more concerned that you strategically understand what's going on. I'm more concerned you understand the concepts. I'm more concerned you understand the vocab. You start using the right buy, ask, what's my spot rate? What's my exchange rate? What's my exercise rate? Remember, or price? What's the exchange rate? So you're learning new vocabulary. And now I want you to start incorporating those vocabularies when in discussion in the lectures with me or in the forums, or incorporate them. You have to incorporate them in your paper, or that we'll be talking, running your own MNC. That's, the team project that everyone's going to be doing in my class. Okay, so foreign trade with business clients. That's what they do. Why the how financial markets serve multinational corporations. Direct foreign investments or acquisitions of foreign real estate. Short-term investments or financing in foreign securities. Long-term financing. Those are the last chapter we're going to go into that. In international bond or stock market. Remember, those are called investments, if you forgot from finance. Foreign exchange flow chart. Let's see what I had in here. Okay, if I look at the chart, just kind of glance at it. Multinational organization. You'll follow the arrows, exporting, importing, foreign business clients. You see them going back and forth, foreign subsidiaries. Where's the money going? Follow the money, okay? Look at it. You'll do fine. Long-term, medium, and short-term. Foreign subsidiaries. Got different thing, multinational. International Monetary Fund. Long-term, this thing. Medium, long-term finance, international credit markets. Comes in here. Long-term financing, international stock market. Okay? Are we good? Okay. All right, so we finished that. Now, that's everything we have in chapter 3. I want to just pick on again. You will be doing a project for this course, running your own multinational corporation. You're gonna what you're gonna do, your small business, you got a product, whatever, medium business, and now you're going to open up a subsidiary. What should I know for my paper? There's 21 chapters, so what should I know? Using the foreign exchange market is an option, or is it? You have to use the foreign exchange market. Explain how you will use the spot market for your business. Just want to look at the spot market is two. Why did I do that one? Oh, I made a mistake. Sorry, class. There you go. That makes sense. Okay. There's number 2. What bank do you plan to use to exchange the foreign currency received for dollars? You have to, so if I'm doing the Switzerland, the Swiss bank, you tell me which bank. Or it still could be, if you're the host country, Citibank and Chase are, they're they're almost everywhere. You know what I mean? So you could still use that one domestically, and they have that. But are you going to get the best deal? Maybe you may want to use a local bank or to exchange a foreign currency because you'll get a better deal. The larger ones, they've got, it's more liquid, more everything else, but it's the best deal. But then you have to look at the bank and everything else. How long will it be around? Okay. You do research on that. What is the bid-ask spread on the recent quotation by the bank? Your bid and your ask. Okay. What's the spread? How much you want? What are you going to think about for your business, your product, for your financing? Okay. Assessing recent exchange rate. Oh, let's see what I got in here. Okay. Call the bank to obtain the quotation. That's what this one says. So you could call your bank. Well, yeah, you don't even have to call. You could go online, or just a lot of search engines if you want to find out what's the bid or ask spread, and put it for that country, and say, first of all, put into the country, do a Google search, see which banks they are, find the one that is an international bank that's trading. Some banks may be there, but they're just domestic, just smaller banks. You may have to get more of a little larger one within that host country or like I said, you get Citibank and Chase that do a lot. Okay, ascending recent exchange rates. Okay, go to we're doing the currency turn. This is just a web that I want you to look up. You could do this on your own. I'm not going to go in here, blah blah blah. Then click on the currency, and then you explain the main foreign currency for your business and how it has it changed over the last month and has it changed over the last year or not. Okay, so that's going to be so you're building. Remember, you're working just as a team. And as a team, since you're working as a team, you want to split up the work early. I'll work with you as a team to help you spread up the work. What did I do? There we go. All right, so there we go. You've done another chapter with me. Jeez, I'm probably an hour and 10 minutes. Hopefully not an hour and a half. Again, read the book. Even though it's small print, read it. If you don't understand it, look at it. Focus in, go in the back. It's got the key terms, it got the definition. It has problems that you could solve. Look at it, they'll give you examples, and then they'll show you how to solve it. Walk it through. They've got whole sections. I can't cover it all here in an hour and 10, 15 minutes, or an hour and a half, whatever this lecture is. Down the road, I will have certain, when we start getting more to math, I will have just like 20-minute videos explaining how to do it step by step. Remember, some of the sites that you will be able to access here in the book, click on there. They got videos explaining the same concepts with somebody else. Not, I'm explaining a lot of concepts here. The book did a lot for the whole chapter because we're talking international financial markets, securities exchange, credit markets, money markets. But what you're looking at is, so I'm just touching on them. They'll have more specific, or if you're a reader, they'll explain it like anything else. You're going to take this, the author explains it one way, I kind of add to it, but not to confuse you, because most of you, you're taking this in a community college, or this is your basic, your intro to your first international finance class. And you're just learning this stuff, so there's a lot of information coming to your head, so you'll do well. But remember, so take your time, absorb it, read it, and you'll do very well in this course. And that's why just running your own MNC, once the team's, by this time, this is in week chapter 3, you're already on your team. Yeah, I just changed that. So if you just picked me on YouTube, this course is offered at Harper College. Myself, there's several other instructors that teach this. This is just how I present it, from the book, just summarizing it. So remember, your mind maps are your tool. This is, I think, like 50 slides if you looked at full PowerPoint, but it's easier for you to see the whole picture, and you could zoom it in or zoom it out. You could go from one. You could see the correlation between everything else within the financial market. Okay? So again, we'll be next time, so we're good. Again, my name is Dr. George Mochocki. This is International Finance. We just finished covering Chapter 3. On international financial markets. We talked about the foreign exchange market. We talked about the international money market, similar to what you do with domestic, only a little different twist to it, a few different items to consider. Okay, because you're in a different country where the subsidiary is at, or you may be here, but you're playing by maybe a little different rules in terms and conditions depending on the host country, where the money's flowing in or flowing out. International credit market, why does it make sense? Bond market, do I sell my bonds here, or do I sell them at the exchanges at different markets? The same thing with the stocks. Remember, both have an initial. Well, you already had the corporate finance. So you already know they both have a secondary market. I'm not going to go on that. I just explain. I just assume since you're ready, corporate finance is a prerequisite. I should just keep on just moving on and just focusing on the international business perspective. As an instructor, I always want to make sure I have a baseline. Some people may had corporate finance 5-10 years ago, so I had to do a little refresher very lightly. The book does a great job. If this is going to be your discipline, I would keep this book. I want to sell it back. The author did an excellent job. It's a good reference point. It's current. It has excellent websites. Even if you're going for your bachelor's, or down the road you'll be going for your master's. Well, master's is basically, most master programs is like 60% or 50% is all finance. So you'll get to know, you got the accounting, but more finance, strategic. That's what managers do. How do I make money? How do I save money? How do I improve the stockholders' wealth or shareholders' wealth for the MNC or for my company, either it's public or privately held. Okay, so I'll see you in chapter 4, and have a nice day. Remember, you could stop me, you could move me, you could turn down the volume, and if when I open up all my concept maps, I give you the full layout of all of them, even though I'm going to cover them, go real quickly. Stop it, look at it, and use your book. Look at your book. The book's a good reading book on here. Look at the book, use the book, and then it's got a lot of information. I'm not on here. It's got the formulas. Make this as your resources. I will be presented from the author's perspective, not to confuse you. How you solve the problems, so basically a basic generic problem solved the same way, the formulas, but how you approach it, you may approach it a little bit differently, but you're still approaching it in the same manner going forward. And I'll try always present it from the author's perspective. All right, so I'll see you in chapter 4 in a little bit. Thank you.